Imagine it's 2032, 7 years from now. You're walking to your dream apartment or your dream home, and you've got the job that you've been looking for, right? It might have been not right out of college, maybe it's your second or third job, but it is a job you really want. You've got emergency savings built up. You've got cash saved up for either the down payment on a house or the first and last month's rent and a deposit on an apartment. But the landlord or the bank runs your application and they reject you. And why? Because of some small $50 mistake you made on your credit or your credit card years ago, and that one late payment from back in 2025 is still haunting you so that you're not able to get approved for the credit you're looking for. And that's the reality of what I'm calling the 7-year curse. And every mistake that you make today will follow you for nearly a decade. So the last thing you want to do is screw up your credit. So I call it the 7-year mistake. And this is how having a good or bad credit score can control your life. So what really is an actual credit score? So I know some people, they're not quite sure what it is. And you hear this term FICO, and what does that even mean? So I want to cut the mystery out of what a credit score actually is. And it's not this secret Wall Street Journal or Wall Street formula they come up with. It is just, honestly, to think of it in simple terms, it is just a trust score of how you are with your money. So whether it is a bank that you're trying to get a credit card or apply for a loan for, whether it is a landlord that you want to rent from, or an insurance company that you're trying to get either life insurance or some other insurance policies from, even some employers will pull your credit to see how trustworthy you are, depending on what kind of job it is with money and finance. And they just want to know, can you be trusted with money? So like when I was a bank teller, or when you work in a bank or you have access to funds, people just want to know, what is your trustworthiness regarding this? And it all kind of folds back into this credit score. So a high credit score, people think you're reliable. Doors will open, credit will be offered to you at lower interest rates. And a low credit score, you just look more risky, more untrustworthy, and sometimes you'll be denied for things. So doors might quietly close that you didn't even know were closing because of the fact that you have a bad credit score. So, of course, people like Dave Ramsey and stuff like that will say you don't need a credit score for anything. And that's true if you're not borrowing money. Credit scores aren't as important, but it is definitely something that 95% of you out there are going to need to make sure is in a good spot, and you want to make sure you have a good credit score. So here's the kicker with credit scores, though. Mistakes end up on your credit report and on your credit score, and many of them last for 7 years. So if you miss some bill payments, if you miss some medical debt, if you miss or get sent to some sort of collection agency for something, these are moves you could have made in your teens or early 20s, and they come back to haunt you for the long term. It might be even things that you have completely forgotten about that can affect you way down the road. And that's why you really want to make sure you have a good credit score and you don't screw it up. So how and what are the factors that make up your credit score? So when you heard that term FICO scores are typically between 300 and 850, and they're built on 5 ingredients, okay? So each of these ingredients is not weighted the same. We're going to talk about what they are. And the first one is your payment history. So 35% of your credit score is based upon this. Do you pay your bills on time? Making sure that you're not obviously late. And they go back for 7 years monitoring this stuff. So for many people, especially during the Great Recession, they were unable to even get a mortgage or get any sort of credit for 7 years because they went into full-fledged bankruptcy. So just know, you want to make sure your payment history is clean, your payments are being made. And like I always talk about, you want to have all your payments automated so that at worst case, especially on things like a credit card, at least at minimum, you're going to make the minimum payment and you're not going to miss a payment. So you don't want to miss any payments because that's, again, 35% of the way they figure out that score. The other large portion is your credit utilization and how much of your credit limit are you using. Most of the time you hear people say you want to stay under 30% of the limit. So an easy example would be if you had a $10,000 line of credit on a credit card, you want to keep that balance under $3,000, ideally under $1,000. But like even for me, I have one credit card I use for work that has I think it's like a $40,000 or $45,000 credit limit on. If it jumps around all that, but you showed for a long history of time that you're able to handle that and make the payments every month. And in all honesty, you don't have to just pay your credit card off once a month. I know a lot of times for myself, I do it intermittently. I have all the apps on my phone. I can literally pay my credit card off every single day if I wanted to, but it's not something you would do. So the history and the utilization, credit utilization, payment history, that is 65% of it. Now, the other 3 is the length of your credit history. So if you're someone in your early 20s that just started getting credit, this only works for 15% of the score, but it is just showing that over the long haul, you were able to use credit smartly and wisely. And again, this is part of why they'll tell, especially young people, if you have a credit card that you paid off, rather than close the account, cut up the card, throw it away, but leave the account open. So that way it's showing you still have access to that credit and you were able to use it and use it smartly and not need to use it anymore. The fourth one is credit mix. So this is 10% of it. It talks about the variety. So if you have a credit card, a car loan, a student loan, a mortgage, any kind of different types of credit, it just shows up as 10%. And then the last one is new credit. So every time you apply for something and your credit is pulled, a hard inquiry is what they call it, you don't want to have too many of those. So too many of those in a short time will throw up some red flags that why are they looking for so much credit? And so that is also considered 10% of this breakdown of that. So why are these numbers important? And these are what I'm going to talk about first are the sins, the cardinal sins of how people screw them up. And of course, one is paying late. Doesn't matter if it's a $30 late payment or a $3,000 late payment. You don't want to make your payments late. The second one is you do not want to max out the cards if at all possible. And I understand people have financial difficulties and emergencies. So if you have a $1,000 credit balance or a limit and you spend the whole $1,000 and now you're above the limit, that's not going to look good. It makes you look like, oh my God, I don't have any money. I must be in a financial problem. So they'll give you big lines. Like I have some big lines of credit. I never like to use them. They're just like break glass in case of emergency. But just know you don't want to make those, maxed out. And the other one, of course, is closing old accounts. For someone like me, that's going to be 55 soon, closing an old credit card, not as big a deal. Someone that might be in their 20s that might only have one or two cards. But for someone like myself who showed credit worthiness over, 35 or 40 years, not as big a deal for me to do that. So with that being said, credit scores between 300 and 850. If you are 800 and above, you are considered excellent. If you are between 740 and 800, you are considered to be very good. And for someone like myself, who my day job is being a real estate agent, helping people buy and sell homes, typically if your credit's 740 and above, you have no problem getting a mortgage. It's just a matter of what your income level is and what your debts look like on how much of a mortgage you can get. 670 to 740 is considered good, and typically those people can also get a mortgage. It's when you start getting below those numbers, it becomes a little more difficult. So 580 to 670 is considered fair, and anything under 580 is considered poor. And so once you get down in those low credit limits or you're showing your credit score to be pretty bad, then that's when you have to be really careful. And here's why it's important, and here's how it affects you. So I want to talk about what the real cost of bad credit is. And I know having a low credit score, if you don't need credit, is not a big deal, but it's not just about getting approved. If you have a higher credit score, you're going to potentially have a lower interest rate. So we're going to show you a little example here on the screen about a car loan. So let's say one person has a 720 credit score. The other person has a 580 credit score, and we're going to go out and buy a car, okay? So this is how the numbers work. The 720 person was able to buy that car at a 6% interest rate. So their payment was $440,000 a month, and the loan balance was 20 grand. So they borrowed 20 grand at 6%, $440 a month was their payment. The person whose credit score was 580 was paying a 14% interest rate, so more than double, and their monthly payment was $575, which is $135 a month more, and $8,000 more over the 5-year loan for the same car or the same loan of a car for $20,000. So again, having that bad credit wasn't that you weren't able to buy the car. It's just you had to pay a lot more money over that same time period to do it. Same thing here works on a mortgage. So let's use an example of a $3,000 loan, okay? If you do that, a person with a 620 credit score could pay $75,000 or more in interest than someone with a 740 credit score. And the same thing works on an insurance example. And in many states, poor credit means you're going to pay 50 to 100% more for car insurance. So again, imagine, and you know me, I'm always going to sports reference everything, is imagine starting every game down by 20 points when the game starts. They blow the whistle, the game's going to start. You have to start 20 points behind. Well, that's what happens when your credit score is low. To buy and purchase the same things, you're going to pay more. You're going to potentially not even get a chance to, or you may be approved for lesser amounts of money. And so because of that, you may get a less nice car or a less nice house, or just pay more for things that you really don't want to feel like you have to. And so, it's not an easy thing when your credit score is bad, and we got to do everything that we can do to fix it. So, common myths that are keeping people broke due to some of their having a bad credit score. And so here are some reality checks, some myths, some things that people think about when they talk about your credit scores. And here's the first one. Checking my score hurts. No, doesn't hurt. The only time that people even know you're checking your credit score is when there's a hard inquiry. So if you apply for credit and they pull your credit, that potentially could hurt, especially if you do it too many times in a short amount of time. But just checking your credit score online, if you go to one of those services to find out what your current credit score is not going to be a problem, okay? Carrying a balance will help my credit score, and that is false. You don't need debt just to have your credit score go up. Like I said, if you use small amounts, maybe you pay your gas every month on a credit card, or you have a few bills that you know you automatically just pay on your credit card and pay them off in full every month, that's great. You do not need to carry debt going forward. That is not going to be a help for your credit score. The next myth is about debit cards. Debit cards don't build credit. All a debit card is money going in and out of your checking account. So this doesn't really help you as far as get a better credit score. Obviously, it shows you can use it smartly, but that's not going to show up on a credit report. And the last one is closing a card boosts your credit score. Now, really, for someone my age, if I close a credit card because I don't use it anymore, not a big deal for me. But if you're a young person who are talking to in these videos and you have a couple of credit cards and you close one out and don't have much of a history, you're better off leaving that open. Cut up the card, throw the card away, don't use it once it's paid off in full. But at least for now, you're better off not closing out the account, just leaving it open and then just not using it anymore. So how do we fix some of these things? How do we beat the system? How do we do it without having stress? How do we do some smart things in order to increase our credit? And here's what we want to do. Okay, here are some simple, easy things we want to do so we don't have any problems. Is one, automate the payment. So you want to make sure that at worst case, the minimum payment gets made every month. My card, which I usually pay off in the middle of the month in full because I just wait for some office bills to come through and then I just pay the thing off. But it is set up. And every time I go to make that payment, it says, do you want to cancel this month's automatic payment? So set up automatic payment. At least that way you'll never have a missed payment, okay? To help do this, put your subscriptions and some things you automatically pay on your card. So when you are keeping some of these subscriptions, say it's Netflix or Spotify or Apple Music or whatever it is, have them just built to your credit card every month, then pay them off in full every month, and it just shows you're able to use your credit smartly and wisely. Again, keep old cards open, keep your balances low, preferably below 30%, and then check your reports on an annual basis. So don't be afraid to check your scores, check your reports, make sure that there's nothing on there that shouldn't be. It happens a lot in my day job where we're doing real estate. Someone goes and applies for a mortgage and then they find out, oh shit, there's something on here that was taken care of a long time ago, and you want to make sure that it's not there. So why is this so important in your 20s and 30s? If you're young, this matters way more than you think, and it's setting up your entire future because having a good credit score makes things a lot easier. So if you want to buy a house, your credit score is going to decide how much money that you will be able to borrow and at what rate. Obviously, your income plays a role in that. Do you want a nicer car? Sure as hell, from our example earlier, don't want to pay more than you have to for the same vehicle because you have a low credit score. So having a higher credit score will allow you to get a nicer car or have the same car that you would have bought in the first place and pay a lot less over the 3-5 years of that loan. And if you want to rent an apartment by yourself or with your girlfriend, the landlords, we do property management on my real estate team as well. We are going to pull your credit. And if your credit's terrible, we can't rent to you. Legally, we're not going to be able to rent to you. So the system doesn't care if you're being responsible in the current moment. It cares over a 7-year time frame. So you don't want to screw up your credit. And when you do, then it takes time to recover. And it just makes this whole winning at money and finance game a lot more difficult. So here's the takeaway. Here's what I want you to do. You need to protect your credit score like it's your personal reputation because it's your financial reputation. It's basically showing people that you want to borrow money with how your trustworthiness is regarding finances. So in the comments down below, here's what I would love for you to do, and I'll share along with you. What is the biggest money mystery that you want me to break down in the future? So obviously this one's about credit scores. If there's other things you don't understand or things you want to know about, by all means, whether it's investing, whether it's trying to figure out what to do with student loans, or if you're just feeling broke and not sure how to get ahead, put the comments below. Tell me what you want to hear about, what things you want to know about. And of course, subscribe to the channel because I can promise you learning a lot of these things now will save you pain down the road. And if you go back and watch a lot of the old videos, there's a lot of great information in there. And again, once this channel gets a little bigger and we get a few more people following, then we're definitely going to make sure that we put a little class together and that we can interact with you and teach you step by step, even more in detail on what you need to do to win at this game of money and financial freedom.